Bring that ass back like a boom, 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 boom.
So guys, this is the first video that I promised you. As I said, I'll split them in two. One is the charts, one is the Holy Grail, and I think I should start with the Holy Grail, just bring down the tension a little bit because everybody's expecting to see this new indicator that basically calls the tops and the bottoms right at the spot. Well, not. I don't have this indicator, nor I think anybody else does. And I think that this search is rather useless, but there is something that has been around for quite some time and people underestimate it, and it's called mathematics. So I do believe that mathematics is the real holy grail to trading, and when it comes to that, I need to make a disclaimer. The first one, I'm really surprised by still how many people in this business do think that a higher hit rate means that you're going to be a profitable trader. It's funny in Europe. Brokers on their webpage, right at the front of their webpage, are obligated to mention the success rate of their account holders. And there's not a single broker that can claim a success of more than 30% of the account. So basically 70% at least of the accounts within the broker are losing money. This is staggering given all the indicators and all the charts and all the tight spreads and all the commissions that are basically gone and all that stuff. I mean, this has been changing in a very positive light for people like me and you, which are retail traders, so to speak. And yet, this number hasn't really moved through the years. So at this point, you have to think. I mean, how is it possible? I mean, if you have all these tools and you think that technical analysis or fundamental analysis is the answer to it all, why is it not working for people? And the simple question is that it has nothing to do with indicators from the fundamental analysis or complex charting strategies and trend lines and stuff like that. Yep, I use them, but I still don't believe they're the answer to all of your troubles. This right here, however, I believe it is. But let me just tell you one more thing before I quick and explain what I mean right here. There's been a study done with over 50 million trades. That's again Europe, that's Forex, the currency exchange market. And it has been done by a broker in Europe analyzing more than 50 million trades of its clients. And you know what was really interesting? The percentage of winning trades was 67%. So 67% of the trades were actually winners. Right, so this is remarkable. You would think, whoa, okay, so people are making money. Well, not quite. You know why? Because the average loser compared to an average winner was 1.66 points for every 1 point. So for every 1 point they made, they lost 1.66 points. So the loss was larger than the win. And now we go back to the variables. For the Holy Grail to work, or for math to work for you, the first thing you need to know is the risk of your account equity on a trade. So basically that's something that you have to decide for yourself. I personally am comfortable risking 1% of my account equity on a trade. Some people are comfortable risking 2% of their account equity on a trade, but I think that anything above 2% is being reckless. So I think 1% of your account equity, for me especially, it makes a lot of sense. And this determines my stop loss. So basically, I understand that when you're trading, for example, breakouts, and you see this wonderful base, you want to put your stop loss ideally below the base. Well, here's my problem with this strategy. Everybody else puts their stop loss below the base. And usually the base is 5, 6, 7% wide. So your stop loss has to be at least this. I don't like to risk 6, 7, 8% on a trade, because in order for me to make the same amount of money, 1 hour, so to speak, I need to have this trade running into 6, 7, 8% profit. and this can take some time, and I'm not that patient. Also, this will give you a very low amount of exposure. So basically what I mean, if you are risking 1% of your account on a trade and your stop loss is 10%, just to make it easy for my head calculations right now, that means that you can only risk 10% of your account on this trade. And this is not going to move the needle too much if it moves. Which also means that if you want to be fully invested, that's 10 trades. And if you want to go on margin, that's 20 trades. And 20 trades, even 10 trades, it's difficult to manage. So I ideally want to have 3, 4, 5 trades that are maximum exposure. So 20, 25% on each trade. And if they're gone fast, okay, that's fine. So the way you can do this is if you have a tighter stop loss. So a tighter stop loss of like say 2% can give you the ability to basically trade 2 positions in your non-marginable account. So basically, if you're not going on margin, you can trade 2 positions with 2% stops, and that's a total of 1% per trade on our account equity, right? And this moves the needle. For that reason, there's a second video that I will explain where and when I want to get in, what are the conditions in order to get into a trade. So we basically get this explosive move. If we don't get it, we're out. I mean, there's just makes no sense. I'm sorry. But this is the first question that you need to answer for yourself. What is the risk of your account equity on a trade, on a single trade that you are comfortable losing? Now, if you tell me that you are comfortable losing 1%, and the moment this trade moves against you with 0.5% of your account equity, and you're like, oh my God, what's going on? Then you're not comfortable with. You really need to be comfortable with. So basically what I'm saying is you place the trade, you place your stop, and you just get out. Don't even look at it. Just get out. Do something. Walk. Go in the yard. I mean, play with your kids and with your family. I mean, watch a movie, whatever. It doesn't really matter. Just get out. Leave it there. That means you're comfortable with. So, once you have the idea of how much you want to lose on a single account, on a single trade from your account equity, then you have to keep track of 2 important stats. And this is the average loser against the average winner. So basically, if the average loser is 5%, we say this is 1 R. What is your average winner compared to the average loser? So if you're losing 5% and you're winning 5%, this is a 1-to-1 R. And then you have to keep also track of the amount of the number of winners against the number of losers. That's also important because these 2 will basically form your Holy Grail stat, right? So it's a numbers game, as I said. Just for a second, imagine we have an average loss of 1 R to an average gain of 5 R. And winners versus losers is only 25%. So out of 100 trades, 25 are winners, 75 are losers. And if I just show this to a person, they just look at it and like, what, 75 losers and 25 winners? There's no way this person is making money. Well, guess what? If you're making 1 to 5, that means that you have 1 times 75, these are the losers, and 5 times 25, that's 125. So 125 to 75, winning versus losing. You're making almost double. Nobody could believe it with 25% hitting rate. Guess what? Most of the breakout traders will be running between 25 and 40% hitting rate at all times. That's it. 50% is a mirage. It's a whoa. We don't get there. I don't get there for sure. I mean, I'm 27, 28% most of the times. So that's why you see my stops getting hit so often. But my average stop is about 1.8%. I don't really care. I mean, I can play this game all along. Yesterday, Tesla, $940 stock, 7%, $7 stop loss. You know, I cannot even calculate it. That's less than 1%. I can play this game all day long. But that's the numbers game. That's for you to explore. So basically, try to start keeping track of those 2 statistics. That's all you need. So you need the average loser, you need the average winner, and you need the number of winners against the number of losers. That's it. You don't need anything more than that. And then when you have that, and when you compile it into stat, you'll understand how powerful this stat is to basically show you the direction in which you need to improve. Whether your losers are too big compared to your winners, whether the winners are too little against the losers, or the losers are too little against the winners, you have to understand. You will see, and you'll see whether you cut your trades a little bit short, because this is the biggest problem. After all, the first one is letting your losers run, and the second one is not letting your winners run. Both of those problems stem from a single feature from our, primal brain, if you want to put it, and that's avoid pain at all cost. Your brain is screaming, avoid pain. And I'll say, why avoid pain? Well, when your loser is running, there's always this hope, right? So you're not closing the trade, basically losing money, which is pain, just because there's hope. And hope is one of the strongest feels out there. I mean, there's always hope, right? So you can leave it right there, and it will turn around at some point, and you'll be happy, elevated, and whatever. So your brain is trying to tell you, don't cut it, don't cut it, don't cut it, avoid pain, don't worry about it, it will be okay. And the other one with the average winners, hey, we just made 2%, let's take it. Why? Well, because guess what? It reverses back to your break even, you don't make any money, and now you're in pain. Oh my God, I should have taken the money. Move your stop loss to break even. Oh my God, let's protect those money. What's wrong with you? It's your primal brain. That's it. That's what's wrong with you. And it's not wrong with you. I mean, this is how people work. Your brain has been there for centuries and ages trying to protect you from inflicting pain on yourself. So that's what it's doing with your trading as well. It takes mental preparation. Let me tell you that. It takes mental preparation. And the mental preparation and this mathematics, it's what will take you to the next level. It's not in indicators. It's not amazing software, screening, scans, whatever. It is not. Get it. The best traders are not best traders because of an indicator. They're not best traders because of trend lines or stochastics or this secretive information that comes 5 milliseconds before everybody else. The best traders accept risk. They know that it's okay to lose, and they're okay taking the risk. So if you take one thing from this video, is please start tracking your average loser versus average winner and the number of winners against the number of losers you have. That's all you need, really. That's all you need. Once you have this, you'll have a clear picture of what you need to improve in order to become a better trader. So in the next video, I'm going to be talking about the setups, the charts, the indicators, and all that funky stuff. But this is the more important video by a mile. So see you in the next video.